And welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. Thank you to those who are following the portfolio on eToro. If you're not already doing so, click on the link in the description and you can add us to your watch list, or if you've got some funds that you would like to invest into the Crassus Investment portfolio that I manage on eToro, you can download the app, add some funds and hit copy, and away you go. So today we're going to talk about one particular company that I've started scaling into. It's a new position for the portfolio, and that is Genworth Financial. So this is an insurance business, pure and simple. We do own another insurance business, the Allstate Corporation, and you may have been following my video on Fiserv, where I believe that the portfolio was a little bit underweight some of the financials, and so this is another player in that position in the portfolio when it comes to financials. If you haven't already liked and subscribed, greatly appreciate you doing that. Helps get the channel out there, helps getting more views and more awareness. And thank you for all the comments that I've been getting. I greatly enjoy the discussion in the comments section. The Crassus investment formula: we're looking for companies with low debt, margin of safety, sales growth, strong margin, free cash flow growth, and ideally a history of share buyback. So if we can get all of those, we're starting at a reasonable price. We're starting to look at an attractive investment opportunity. Okay, quick facts on the company. This is a company that's still lingering from the GFC, where they had a lot of bad loans. They're slowly getting rid of those and cleaning up the loan book, but it's an interesting play from an asset perspective. So revenue is expected to come in at 7.9 billion at the end of the year. Operating income, remember it's an insurance company, so they don't publish EBITDA as such. So operating income 1.2 billion, market cap 2.1. Enterprise value 3.4, and the current share price at the time of recording is $4.29. 507.39 million shares outstanding, flat on repurchases. So they haven't issued, they haven't repurchased, they haven't really diluted or reduced, and the return on capital is just under 9%. So okay, not too bad for a company of that size. But what's interesting is the book value. Okay, so the value of the assets, being assets minus liability, on a per share basis works out to be around about $30, which is obviously a humongous discrepancy from where the current share price is trading. So that's interesting. We've got to do some more work and find out why that might be. The net debt to EBITDA, or operating income, being an insurance company, 0.3 times, so they should be able to service that. Plus they have the ability to raise some more cash, which I'll talk about in a moment. Okay, last 5 years, the company's gone nowhere really. I mean, it's gone up and down and up and down and up and down. The reason for this, they did have an acquisition bid on the table that dragged out literally for, I think it was 6 years, and they finally last year said that they're not going to go ahead with it. There was a Chinese company trying to buy it out, and it was just, I don't know what was going on, but it's just, it was one of those things. Talk about corporate management and bureaucracy. In any case, that seems to have freed up things moving forward for the company. The key points: it's an insurance company, mainly operating in life and mortgage. They have exposure to the US, and they also have exposure to Australia, so Genworth Financial Australia. The market cap's 2.6 billion, there or thereabouts. The cash on hand is 2.6 billion. So you're basically buying the company for the cash on hand. There is a reason for this. The market is worried about the value of this liability stacking up from loans that they have written in their long-term care insurance business way back, and there's some doubt as to whether they have the cash to cover it, but we'll talk about that in a moment. It is an asset play. Okay, so stocks trading at discount to book value. You may have noticed recently that the tune has turned towards looking at asset plays out there in the market, and that is simply, if you look at metrics on the overall US market, particularly as a whole, if you look at earnings yields and so on and so forth, the market cap on these companies have just gone out of control. So the ability to invest and get a decent return based on a cash flow situation alone is kind of getting out of hand in a lot of areas. There are some opportunities. However, if we look at assets, it provides an extra margin of safety. We don't know what's going to happen tomorrow or next year or the year after in terms of the market. Maybe there'll be a crash, maybe there won't. I don't particularly think that there will be. But in regards to inflation and with regards to providing that extra buffer, if we're buying companies at a discount to their assets, as well as a discount to their present value of the future cash flows, we're adding an extra layer of safety in. And so it's obviously another thing to keep in mind. Hidden assets on the book. So they had part of their insurance business, life insurance, was Enact Co. Okay, so they successfully spun off that company and floated it. Okay, so there was an IPO, I believe it was on the NASDAQ in September the 26th. The valuation for the company was valued at 3.26 billion. Okay, so that's what this entity, this sort of spawning entity, they had a parent company. Enact came out and was spun off and then floated on the stock exchange for a valuation of 3.26 billion. So if you stop and think to yourself, okay, well, Genworth, its current market cap is 2.6 billion now, and yet this subsidiary company that they owned has been valued at more than the current market cap for Genworth. So we're already at an interesting discount. And as I say, this is more than the entire market cap for Genworth as it currently stands. Here's the thing, Genworth still owns 81.6% of the shares, okay? So they didn't float all the shares, they floated, 19.4% of Enact's market cap and sold those shares to the public markets. And so they still retain a massive interest. So if you flipped the script and said, okay, well, forget everything else Genworth owns. If you look at Enact and simply took the market cap as a broad valuation and said, what is 81.6% of that market cap, you end up with about 2.66. Okay, so that says that based on that alone, Genworth is slightly undervalued or trading at a slight discount. So it's quite bizarre to see this. The risk. So why is that? Why are we so lucky to look at this particular company trading at such a massive discrepancy? Well, there are worries about the future. So premiums on the long-term care insurance policies, once they've been written, they cannot easily be increased after the policy's been written. So if you're in insurance, you'll know that there are stepped and level premiums. So if you opt to pay level premiums, you're paying the same amount, and that never gets increased over your lifespan. Whereas you can pay a cheaper amount up front as a younger person, but opt for stepped premiums. And so you're paying less at the start of your life when you're not likely to use life insurance, or in Australia we call it TPD, total permanent disability, or long-term care. You're not likely to want to cash out on those policies, and so you can get away with paying a smaller amount in premiums up front, but they increase as a step function, hence the name step premium, as you get older. Now this is subject to state law, so this could be a really tricky situation where if you're operating in the United States, for example, and you might be able to get a motion passed that allows you to increase your premiums to a certain amount in one state, but not necessarily the other. So that could be a big problem when you're a nationwide company. They have managed to get some of those motions approved in 12 states. The company is seen as being overly reliant on their 2% lapse rate. So it's expected that after 40 years, the way insurance works, if the company has a 2% lapse rate, so people just stop paying insurance for whatever reason over time at 2% a year compounded, the way that works out is that after 40 years, you reduce the liabilities as a percentage, so that the liabilities that you have to pay out, the claims, it comes down to about 20% of the original amount. So you've got all these people coming in at the start and they say, yeah, I'll buy an insurance policy, they pay their premiums. Over a year you have this reduction or this attrition at roughly 2% compounded negatively per annum. And so at the end you've got this pool of people that's only 1/5 or thereabouts of the size of the original customers or policyholders. But that might be good in life insurance, but apparently in LTC those lapse rates are nowhere near the same. Okay, so in fact they're closer to zero. So that means that there aren't the same amount of people dropping off over time, and so at the end, where these policies are starting to mature or having having a greater likelihood of people getting these long-term care. So as you get older, you have strokes and heart attacks and disabilities, and you're going to want to claim on your long-term care policies. Now they're almost a ticking time bomb, and you don't have a reduced pool to which you will have to pay out the liabilities of the claims. You'll have quite a large pool, and the question is, does Genworth have the ability to pay out those claimants? Okay, so that's that. I've stated that. Company announcements. So Genworth made strong progress in its 2022, receiving approvals on 344 million of incremental annual premium increases during the year. Okay, so they were able to increase some of those premiums. In the aggregate, the company estimates it has now achieved approximately 14.5 billion in net present value from the approved increases since 2012. So they're doing their best to plug this shortfall that the market's afraid of. The company continues to work closely with the National Association of Insurance Commissioners and state regulators to demonstrate broad-based need for actuarially justified rate increases in order to pay future claims. So they will have the burden of proof in explaining to the court that there is an actuarial basis for them to be increasing the premiums on policies that they've written in the past. They've said, hey, things have changed, it's not what we expected, and if we go bankrupt, basically you're going to have all these claimants that aren't going to receive their policies anyway, so it's in everyone's best interest for you to pass or allow us to modify according to an actuarial schedule the premiums that people will be paying. Okay, we've gone there. Moving forwards. So, super basic back of the envelope projections. We're looking at earnings. You know, I don't like to use earnings because it takes into account a lot of non-cash items. However, for insurance companies, it's far easier to do that. If we look at the expected earnings per share coming in as of next year, okay, so just under $1. The PE that I've chosen is 8. Now that's a big step up from where they're currently trading, but it is below the industry median. Okay, so they're trading at about 4.5, just under 5 times the earnings, which is extremely cheap. I don't think it's a stretch once the company's demonstrated that they can get their debt liabilities under control and that they're making headway, which they clearly are. They will be solvent. They will be able to pay out their claims according to new schedules, and they're trading at such a massive discount to their book value. I think you'll see the market start to re-rate the multiples of their earnings, okay? Especially if we're moving into an inflationary environment where people just are not getting yield on their cash. People are going to start to bid up equities even more than they already have so far over last year and this year. So if that's the case, it gives us an implied price of $7.92, which is 1.85 on the upside. So big increase in potentially short amount of time, but obviously we don't know how long it will take the market to, or if the market will re-rate the shares. So we add an extra year. We said, okay, if it takes the market 2 years and we discount the time value of that money, that still works out to be a 36% IRR, which is very, very healthy. Okay, so we would take 36% IRR almost any day of the week. The true question is, okay, if we're valuing this as an asset play, what's its book value going to be, and what multiples, or what is the market going to value that book value at? So here I've done a very, 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 very simple table, okay, and said, you know, if they lose, if the board does something disastrous, which you never know, it could happen, the book value goes down and book value goes up, and here are the multiples that the market might pay for that. Long-term median is just under 2. I think it's about 0.18. So we've got 0.15, which is where it's currently trading in around that $4.50. That's just simply too low. I mean, the value of the assets, you can normally, even in a bankruptcy, distressed sale, you can sell the assets for 20-30 cents on the dollar. I mean, it's really not that hard to get that. So we'd be looking at around this 0.25, and so if the book value remained the same and they didn't grow at all, they didn't add any value, you'd be looking at $7.50 just from the value of the assets and the loan book by itself. However, what I've done is add all of these up and equally, so given an equal weighted average, and that is expected to be $7.30. So still a healthy return if you look at it from the earnings perspective, or if you just do it as a straight asset play and look at the the book value and apply a valuation conservatively. Looking out over a longer horizon, if we use a historic growth rate and we use conservative multiples and we apply a base, a bull and a bear case with individual probabilities, this is what we get when valuing the company based on the earnings. Okay, so we get an intrinsic value, discounting at 20% because I want to get at least a 20% compounded rate of return expected for me to want to venture into the public markets. Intrinsic value of $6.72, margin of safety of 4.43. So if we can basically buy the company today at 2/3 of its intrinsic value. So using Munger and Benjamin Graham and Warren Buffett's idea of buying things at 2/3 of their intrinsic value, that would suggest to us that if we believe the analysis that we've done, this is a great opportunity. As such, I think it's a buy. It's a low enough debt in the sense that they can service that debt. Margin of safety is there from an asset valuation perspective. Sales growth are there. They're not strong, but they'll be good enough. They don't have particularly strong margins. They're okay. Free cash flow growth is there. Share buybacks are not really there, but they're not diluted either. And so I'm going to start building out a position of 2% of assets under management. And then we're going to see what happens with Allstate. So Allstate could be further exposed to auto insurance. We'll see whether their drop in earnings this year as a result of increased claims in the auto sector is just a result of people getting back on the road again after COVID, and that explains the spike. Or if we see that their earnings and their conversion rates seem to be dropping, then we may have to cut the position and roll that into another play, like potentially a Fiserv, Genworth Financial, or another company in that sort of financial insurance sector. Thank you so much for watching. If you haven't already checked out the portfolio, click on the link below and that'll take you to eToro, where you can add us to a watch list. And as always, if you haven't liked and subscribed, we'd greatly appreciate you hitting the like and the subscribe button. And if there's a question or comment that you'd like to make, leave it in the comments section and I'll do my best to get around to it. Otherwise, I wish you all the best. And standard disclaimer, I'm not your financial advisor. I don't know your situation. None of this is advice. This is just simply what I'm doing with my money and with the portfolio that I manage. Everything here is just my opinion, guys. You've got to do your own due diligence and take responsibility for your investment decisions. Thank you so much for watching. I'll be back with another episode in a future video, and I'll see you then.